is Qualcomm down nearly 7%? I can only guess it's because Apple's most recent chip effort, the M1, has gotten such solid reviews. But to look further into this and other tech news, joining us now, Mark May, Stifel's Managing Director of Internet Investment Banking, and Natasha Lamb from Arjuna Capital. Happy Friday to both of you. Mark, my take is that if people are looking at this Apple starting modem work news and are negative on Qualcomm because the M1 looked so good versus Intel, they're kind of missing it here, because ARM is an option for everybody to go and make their own custom chips if they want to compete with Intel. If you want to make your own modem, there's not some ARM out there that's helping you make your own modem. It's not like people can follow in Apple's footsteps, right?
Yeah, I think you're right. Look, this topic is less important to my coverage universe of internet. Where really the topic of the day is IPOs that have been off the charts, not just this week, but this year as a whole. That's really been dominating kind of my conversations, as well as a robust M&A environment. But I think you're right. Look, this is an example of it's hard to predict how markets are going to react, even when news is out there. I think, John, you mentioned this shouldn't come as a surprise yet. You're seeing Qualcomm stock down, 7%. It reminds me a little bit of the pricing of the action on some of the internet IPOs this week alone that have popped over 100%, despite the fact that we're experimenting with new ways of trying to set pricing in these IPOs to deal with one-day pops. But it's hard to predict sometimes how the public markets and the retail markets are going to react. But yeah, interesting dynamic.
Well, what do you make of these pops that we've seen? I mean, they're very exciting to look at the stocks move, but I mean, it suggests that investors had a really hard time, or the companies, I guess I should say, and the bankers had a really hard time gauging demand, and ended up leaving some money on the table, and maybe it leaves less upside for retail investors.
Yeah, I think, again, it is there is no perfect formula for how to take companies public. The direct listings have been done. Most of the stocks did not perform all that well in their first even year or so post IPO. The new book building measures haven't always worked. I think it's part of it is supply demand, as you mentioned, John. There's not a lot of stock out there for these businesses, but the retail market has gotten very active here and can be unpredictable. We do tend to see bigger one-day pops, not surprisingly, with the better known brands out there. Whereas, say, a Unity Software, which is an amazing company, had a more modest. They had the similar book building process, but had a more modest one-day bump, not a household name. So I think a lot of that is tied to the retail side of the markets.
Natasha, there are some stories on the tape today about just the IPO window, where we are, and reminding people of the dynamic that has historically been in place, and that is that it's not a signal of an immediate top, but maybe a medium-term top. Are you going there? Are you seeing analogs to the late 90s?
Yeah, I mean, I think it feels like the irrational exuberance in the IPO market that we saw during the tech bubble. But in fact, the money left on the table, which, the difference between the IPO price and the first day stock price at both DoorDash and Airbnb is close to what we saw in the IPO market just last year, where the average money left on the table was $62 million. So if you go back and compare that to the height of the tech bubble, on average, it was $78 million. So DoorDash leaving $32 million on the table and Airbnb $58 million doesn't hit those prior levels. Plus, while DoorDash was up over 80% and Airbnb up over 100%, the top 5 IPOs this year on opening day were up nearly 200%. So, it's been a big year in IPO land, the best since 2014. 204 companies have listed so far, and IPO proceeds are up nearly 70% over last year.
Shepard Smith here. Thanks for watching CNBC on YouTube.